Hey guys, welcome back. Hope you all had a wonderful New Year's. If you guys watched it or just was actually there in any of the countries or the cities of the countries that did celebrate New Year's, hope you guys had fun, stayed safe, and don't have COVID, or stayed warm if you guys know. Today we're continuing on with our book, The Deficit Myth by Dr. Stephanie Kelm. Hope you guys liked the last video, and let's continue on. So it's unusual to see a Fed chairman so frankly admit error. But notice that Powell didn't question the legitimacy of the Nauru as an essential policy guide. Instead, he blamed himself for having misjudged precisely where the Nauru lies. It's this underlying faith in the idea that there's some inescapable constraint on the economy's unemployment potential that caused the Fed to systematically underestimate the extent to which the unemployment rate could safely fall. This misreading drove the Fed to raise interest rates in the hope of choking off a further drop in unemployment, essentially aiming to deny millions of underemployed and unemployed people across access to jobs, and the belief that the Nauru limit had already been reached. You're considered unemployed if you are actively seeking paid employment but not currently working. Some people are underemployed. They're currently working part-time, but what they really want is a full-time job. Because they're employed, they're not counted in the official measure of employment known as U3. Instead, they're included in a broader measure of unemployment, known as U6, which also includes people who want to work but have basically given up on hope of finding a job. And the problem don't end there. As former Fed Governor Daniel Torrio confessed, the Fed has no reliable theory of inflation guiding its day-to-day decision-making. It has various conjectures, assumptions, and models, but many of these are unproven or indeed unprovable. It's all something of a guessing game, where people's lives are on the line. Far from being an exact science, the core guiding principle of the Fed's approach is best described as faith. Faith that their understanding of inflation is more accurate than not. Faith that their tools are powerful enough to manage inflation. And faith that whatever other uncertainties may exist, excessive inflation is always and everywhere a greater threat to our collective well-being than excessive unemployment. Faith contested. Even as scientists and engineers constantly innovate, creating new medicines, technologies, and techniques to eradicate diseases and solve human problems, the majority of economists remain wedded to a 50-year-old doctrine that relies on human suffering to fight inflation. In recent years, a few senior insiders have voiced concerns about the Fed's framework and indicated an openness to rethinking their approach. But most mainstream economists remain wedded to the idea that there is some lower boundary below with unemployment, which unemployment cannot safely be permitted to decline. Some slack must be maintained in the form of a human sacrifice. Forced idleness, lest we condemn ourselves to the ravages of accelerating inflation. Because they accept the concept of inherent trade-off between inflation and unemployment, the Fed is forced to think in terms of how much unemployment to keep in the system as a sort of insurance policy. Against fighting inflation, they simply see no other way to achieve low and stable inflation. Why not just strive for a better mix of fiscal and monetary policy to keep the economy operating at its full employment potential? Couldn't we achieve true employment by asking the Fed to improve the way it runs monetary policy? Or maybe Congress could help fine-tune the economy with better real-time adjustments in government spending and taxation. Recall that the Fed chooses its own definition of full employment. For them, maximum employment is defined as the level of unemployment it believes is necessary to hit its inflation target. In other words, although it's legally responsible for full employment and price stability, one goal takes clear priority over the other. If it takes 8 or 10 million unemployed people to stabilize prices, then that is how the Fed defines full employment. It's counterintuitive to define full employment as a certain level of unemployment, but politically speaking, it is useful for the Fed as it means they get to claim success by defining away the very problem they were tasked to solve. No matter how many people remain jobless, the Fed can claim it's done its best. And there's no simple way to reduce unemployment further without causing inflation. For those who are still without jobs, tough luck. Thanks for your service in the inflation war. There's nothing more the Fed can do to help you. It's sometimes argued that there are actually plenty of jobs for the unemployed, but that there are structural problems in matching the people who want to work with the jobs that are currently available. Many workers Well, maybe workers are just too picky, refusing to take entry-level jobs because they have too much education to justify accepting low-paid work. Or maybe it's the opposite problem. Those without work lack the education and skills that are required to fill the high-tech jobs of the future. Either way, the problem is matching people to chairs, not a lack of chairs. If only they had gotten the right education or the right skills or had the right motivation and personal discipline, they could find jobs. Now, to kind of break down what she's saying there is something that I've said for a long time, which is a lot of these jobs you go online now. It's okay, you want this job, you need a bachelor's degree, and it requires like 5 years of experience. Well, let's say you're going through college, you don't have that degree yet, number one. Number two, you don't really have all that experience yet, which is they're just closing the door on you right away. They're making it much harder for you to get that job. It's the same thing with recently. Oh, you want a master's degree? We're going to pay you less than 40K a year. Then you wonder why the hell people are not getting a job because they can't get it because the barrier to entry is so strict and it's unfair. So that's what she's pointing out in there. So it's a convenient argument for those who are content to leaving millions behind. But it's not reality. In reality, no matter how smart or hardworking the population may be, the Fed sees too much risk in allowing everyone who wants to work to do so. Some people view this as rigging the game in a way that chronically leaves too many people without jobs. If the Fed believes that Nauru is 5%, then it's only safe to allow 9%, 95 musical chairs, for every 100 people in the game. Others take the opposite approach, pointing to recent evidence that lower unemployment hasn't come at the cost of rising inflation. That is interpreted as evidence that the Fed could do more to increase the availability of shares. Critics from both the left organizations like the activist group Fed Up and the right, such as conservative economics writer Stephen Moore, and the right, such as have complained that the Fed has unnecessarily stomped on the brake pedal. In their view, the problem is not with the Fed's tools, but with the way it wields them. In particular, they believe that the Fed is too quick to raise interest rates, thereby snatching away jobs that would have materialized if the Fed had let things run their course. In other words, they believe the Fed could help the unemployed by cutting rates or at least waiting more patiently for additional chairs to materialize. But even a more patient Fed can never guarantee that everyone wants to work can find a job. Outside of World War II, the U.S. has never sustained anything approximately true full employment. The reason was spelled out in the 1936 by John Maynard Keynes and his most famous book, The General Theory of Employment, Interest, and Money. Capitalist economies chronically operate with insufficient aggregate demand. That means there is never enough combined spending, public and private, to induce companies to offer employment for every person who wants to work. You can come close, and you might even get there for brief periods of wartime. But peacetime economies don't operate at full capacity. There's always lack in the form of unemployed resources, including labor. Most economists are content to allow the market to figure out how many jobs to provide. Congress, if it is to play any role at all, might dedicate some resources to helping the jobless acquire skills to make them more attractive to potential employers. More education, better workforce training, subsidized private sector employment, and the like are seen as pathways out of poverty for the unemployed. MMT sees these proposals as half measures that do little to address the problem of chronic underemployment and unemployment. When there's a chronic lack of jobs, and the solutions can offer is a sort of shuffling around of joblessness or taking turns experiencing bouts of unemployment. As Nobel Prize winning economist William Vickery put it, what the number of jobs is insufficient, attempts to push the unemployed into jobs is simply a game of musical chairs in which local agencies instruct their clients in the art of rapid setting. The truth is, we have placed far too much responsibility on central banks, not just in the US, but around the world. They cannot alter taxes or spend money directly into the economy. So the best they can do to promote employment is to try to establish financial conditions that will give rise to more borrowing and spending. Lower interest rates might work to induce enough new borrowing to substantially lower unemployment, but they might not. As Keynes famously observed, quote, "You can't push on a string." What he meant was that the Fed can make it cheaper to borrow, but it cannot force anyone to take out a loan. Borrowing money puts companies and individuals on the hook for the debts they incur. Loans must be repaid out of future income. To increase its indebtedness, and there are good reasons why the private sector might be reluctant to increase its indebtedness at various stages of the business cycle. Remember, households and businesses are currency users, not currency issuers, so they don't need to worry about how they're going to make their payments. In the wake of the Great Recession, which was itself precipitated by a massive buildup in some private mortgage debt, it became clear that the Fed was struggling to fix the economy on its own. It had already cut the interest rates to zero. It had embarked on a new strategy known as quantitative easing. It was doing everything in its power to hold things together. So it was a frustrating moment for Fed Chairman Ben Bernanke when he appeared before Congress and was grilled about why the Fed's extreme measures didn't seem to be doing much to help the economy recover. Pressed by Congressman Jeb Hensarling of Texas, Bernanke responded, quote, "Let me just agree with you on the following monetary policy. It's not a panacea. It's not the ideal tool. Not the ideal tool. Monetary policy is the tool. By statute, Congress puts the Fed in charge of running the economy. In good times and bad, the Fed is supposed to do it all. And that's the problem. Monetary policy has limited potency. It works mainly by driving consumers and businesses into debt. And debt for the private sector is not the same as the debt for the public sector. When the bottom fell out of the housing market, most Americans wanted to borrow less, not more. Millions of homeowners were underwater, and their mortgages, they owed more than their homes were worth. After a long period of borrowing to finance spending in excess of its income, the private sector wanted relief from debt, not more debt. Without actually using the F word, fiscal, Bernanke delivered the message. The Fed's policy lever wasn't powerful enough on its own. It was time for the other policy tool, fiscal policy, to get back in the game. The problem is that the recession pushed the budget deep into deficit, and Congress had already passed a $787 billion stimulus package to fight the effects of the Great Recession. When Bernanke made his not-so-subtle plea for additional help in 2011, it fell on deaf ears. Congress had become preoccupied with the state of its own balance sheet. When the Fed realized it was essentially on its own, Bernanke pushed in all the chips with an open-ended round of quantitative easing that some experts believe contributed to widening inequality and risky speculation in financial markets. Over time, the unemployment rate fell from 9% to less than 4%. It took 7 years, but eventually the labor market clawed back all the jobs that were lost in the aftermath of the financial crisis. For some, this is a testament to the capacity of monetary policy to rebalance the economy after a recession. To the economists behind MMT, it reveals that shortcomings in the dominant approach to macroeconomic stabilization. A recession that had been quickly reversed with the right fiscal prescription instead became the longest and most protracted downturn in the post-World War II era. To make sure that never happens again, MMT recommends a shift away from the current reliance on central banks to deliver on the twin goals of full employment and price stability. So, next, inflation and unemployment. The MMT approach. The economists behind MMT recognize that there are real limits to spending, and that attempting to push beyond those limits can manifest in excessive inflation. However, we believe there are better ways to manage those kinds of inflationary pressures, and that it can be done without trapping millions of people in perpetual unemployment. In fact, we argue that it's possible to use true full unemployment to help stabilize prices. Instead of relying on the concept of Nauru to figure out when the economy is approaching its productive limit, MMT urges us to think about slack more broadly. Currently, some policymakers look at the official unemployment rate, a measure known as U3, and then try to define how close that number is to the invisible Nauru rate. As the Fed admits, they often underestimate the degree of slack in the labor market, thereby trying to slow the economy even before it has maxed out its productive capacity. That's like leaving money on the table in the sense that every person who could have been employed. Performing useful tasks for society is forever lost to us, a sort of free lunch, not eaten. When we run our economy below its productive capacity, It means that we are living below our collective means. The federal budget might be in the deficit, but we are underspending whenever there is unused capacity. It's like building a high performance automobile and then driving it like it's a golf cart. It's inefficient. When we tolerate mass unemployment, we're sacrificing whatever might have been produced if we had harnessed the time and energy of those who wanted to work but were denied access to jobs. Eliminating this kind of involuntary unemployment has been a concern of Keynesian economists for decades. In the 1940s, an economist with a flair for advancing new ways of thinking suggested a way to permanently close the output gap, the difference between what the economy is capable of producing and what it actually produces at any point in time. His name was Abba P. Lerner, and his idea was to allow the private sector to come as close as possible to achieving full employment on its own and then to rely primarily on fiscal policy to make up any shortfall and total spending. With enough aggregate spending, he reasoned, policymakers maintain prosperity by holding the economy at full potential through a permanent application of fiscal policy. Monetary policy could help, but Lerner wanted fiscal policy. Adjustments in taxes and government spending and change of the economic steering wheel. Here, he argued even more strongly than Keynes before him that the federal government should adjust its own budget to offset any and all departures from full employment. The budget outcome was irrelevant, only real economic outcomes mattered. He labeled his approach functional finance because he wanted Congress to make decisions based on the way its policies would work or function in the real economy rather than worrying about how they would impact the budget. The goal was to produce a balanced economy and one in which jobs were sufficiently plentiful and inflation was low. Achieving these goals might require fiscal deficits, a balanced budget, or a fiscal surplus. Any of those outcomes were deemed accessible as long as the overall economy remained in balance. Functional finance turned conventional wisdom on its head. Instead of trying to force the economy to generate enough taxes to match federal spending, Lerner urged policymakers to think in reverse. Taxes and spending should be manipulated to bring the overall economy into balance. That might require the government to add in spend more dollars than it subtracts taxes away. It might even need to do this on an ongoing basis, meaning sustained fiscal deficits over many years or even decades. Lerner saw this as a perfectly responsible way to manage the government budget. As long as any resulting deficits didn't push inflation higher, the deficit shouldn't be labeled overspending. This fundamentally changes the way we conceive of what it means to deploy the federal budget in a fiscally responsible way. Instead of blaming Congress for failing to bring spending in line with taxes, we should accept any budget outcome that delivers broadly balanced conditions in our economy. Thus, if the budget outcome depicted in Exhibit 2 on the left gives rise to the balanced economic conditions pictured on the right, the fiscal responsibility, then fiscal policy requires no further adjustment, and we should consider the budget in balance. And just as a close look, this is the little chart thing she put in the book so you guys know what she's talking about. Just wanted to share that so you guys don't think I'm just reading the text and there's nothing there. Continue on. To maintain full employment and keep inflation low, Lerner wanted the government to keep constant watch on the economy. If something had happened to move the economy out of balance, Lerner wanted the government to respond with a fiscal adjustment, either changing taxes or altering government spending. Tax cuts could work to fight against unemployment if they could be enacted quickly and were well targeted, meaning that they had to benefit those who would most likely spend the money right back into the economy. To work well, tax cuts need to benefit those with a high propensity to spend out of new income. The reason Trump's personal income tax cuts did little to boost the overall economy is because they were heavily skewed in favor of those at the very top of the income distribution. More than 80% of the benefits went to those in the top 1%, compared with lower and middle income earners who would spend a higher percentage of any new dollar you give them. The rich just don't spend all that much more when you shovel more money into their pockets. Well-targeted tax cuts can work, but a more direct way to maintain spending would be for the government to simply spend money more on its own. Just as well-targeted tax cuts will work better than poorly targeted tax cuts, well-targeted government spending works better than poorly targeted spending. Economists usually prefer spending projects that have a high fiscal multiplier because it means that the initial round of government spending will multiply into many more rounds of spending as dollar changes hands again and again. each time creating some additional demand in the economy. To ensure that government spending provided the maximum boost to the economy, Lerner was adamant that any increase in spending took place without an accompanying tax increase to, quote, pay for it. Instead of following a pay-go-like rule, he wanted the government to refrain from raising taxes until it became necessary to fight inflationary pressures. If inflation began to creep up, Lerner believed that Congress could respond by raising taxes or cutting back its own expenditures. And if unemployment suddenly shot higher, he thought lawmakers should cut taxes or find a way to spend more money and fast. Lerner's insights are important to MMT, but they don't go far enough. We agree that we should rely on adjustments in taxes and spending, fiscal policy, rather than interest rates, monetary policy, to balance our economy. We also agree that fiscal deficits in and of themselves are neither good nor bad. What matters is not whether the government's budget is in surplus or deficit, but whether the government is using its budget to achieve good outcomes for the rest of the economy. We agree that taxes are an important way to reduce spending power, and that taxes should never be increased simply to appear fiscally responsible. But we think Lerner's prescriptions will still leave too many people without jobs. Even if all 535 members of Congress woke up tomorrow and agreed to conduct fiscal policy the way Lerner recommended, and voluntary unemployment would remain a permanent feature of our economy. That there's just no way for Congress to react to changing economic conditions by turning the steering wheel quickly enough to ensure that everyone who is looking for work can always find a job. At best, we might arrive at a closer approximation to full employment, but there would always be a significant cohort that remains locked out of employment. It's also not enough to rely exclusively on Congress to adjust government spending and taxation to fight off inflation once it begins to accelerate. To supplement discretionary fiscal policy, the steering wheel, MMT recommends a federal job guarantee, which creates a non-discretionary automatic stabilizer that promotes both full employment and price stability. Think of a poorly maintained roadway. You get a smooth ride until you encounter a pothole or a bump in the road. You can try to steer clear of hazards, but at some point you're destined to hit one. At that point, you could be in for a rough ride. If you've got a vehicle with good shock absorbers, they'll buffer the impact, and you won't get jolted around too much. But if the shock absorbers are weak, you'd better hang on. MMT enhances Lerner steering wheel with a powerful new shock absorber in the form of a federal job guarantee. Here's how it would work. The federal government announces a wage and benefit package for anyone who is looking for work but unable to find suitable employment in the economy. Several MMT economists have recommended that the jobs be oriented around building a career economy. Very generally, that means the federal government would commit to funding jobs that are aimed at caring for our people, our communities, and our planet. This effectively establishes a public option in the labor market, with the government fixing an hourly wage and allowing the quantity of workers hired in the program to float. Since the price of an employed worker is zero, that is, no one was currently bidding on them, the government can create a market for those workers by setting the price it is willing to pay to hire them. Once it does, involuntary employment disappears. Anyone seeking paid employment has guaranteed access to a job at a rate of remuneration established by the federal government. The job guarantee has its origins in the tradition of Franklin Delano Roosevelt, who wanted the government to guarantee employment as an economic right of all people. It was also an integral part of the civil rights movement led by Martin Luther King Jr. His wife, Coretta Scott King, an iconic labor leader, A. Philip Randolph, the influential economist Hyman Minsky advocated such a program as a key pillar in his anti-poverty work. It's important to note that the job guarantee does not require policy makers to try to divine the amount of slack in the labor market using something like Nauru. Instead, the government simply announces a wage and then hires everyone who turns up looking for a job. If no one shows up, it means the economy is already operating at full employment. If 15 million people show up, it reveals substantial slack in a real sense. It's the only way to know for sure how substantially the economy is underutilizing available resources. Why does the financing have to come from Uncle Sam? Simple. He can't run out of money. It would be nearly impossible for a currency user, such as the state or local government, to commit to hiring anyone and everyone who showed up asking for a job. Imagine what would happen if the mayor of Detroit announced that the city was prepared to offer a job to anyone who wanted to work but couldn't find employment anywhere in the region. It would be swamped with applicants even in a relatively good economy, tens or hundreds of thousands of people would show up, placing an enormous strain on the local government budget. Now think about what happened if the economy went into recession, and the number of applicants doubled at the same time Detroit's tax revenues were falling off a cliff. Remember, state and local governments really do depend on tax revenue to pay the bills. They can't simply commit to spending more when the revenues dry up in a recession. But that's precisely what the program is under the greatest restraint, and when it's most critical. Recall from the previous chapter that Mozart got his kids to do chores around the house by imposing a tax payable only on his business cards. In this sense, the tax, at least from inception, is a thing that causes people to seek employment. MMT reckons that since the government imposes a tax that causes people to look for ways to earn the currency, the government should make sure that there's always a way to earn the currency. With a job guarantee in place, the economy can pass through a rough patch without throwing millions of people into unemployment. The rough patches are inevitable. There isn't a capitalist economy on earth that has found a way to eradicate the business cycle. Economies grow and create jobs, and then, eventually, something happens to throw them into recession. We can and should use discretionary policy to try to tame the business cycle. Smoother rides are preferable to bumpy ones, but no country has figured out how to steer clear of every possible hazard. Over the past 60 years, the U.S. has been hit with recessions: 1960 to 61, 69 to 70, 73 to 75, 80, 81 to 82, 90 to 91, 2001, 2007 to 2009. Good times are followed by bad times, which eventually set the stage for the next round of good times. A major benefit of the job guarantee is that it helps to insulate the economy as it passes through the inevitable boom-bust cycle. Instead of throwing millions of people out of work when the economy softens, the job guarantee allows people to transition from one form of paid employment to another. You might lose a job sorting boxes for a private retailer, but can immediately secure employment performing a useful job in public service, because the job guarantee allows workers to transition into alternative employment rather than joining the ranks of the unemployed. The program helps to cushion the overall economy by supporting wages and preserving or enhancing skills until the economy recovers and workers begin to transition back into private sector jobs. And because spending to hire workers into the program becomes automatic once the jobs guarantee is in place, we don't have to rely on discretionary spending to smooth the ride. The federal government guarantees the financing, establishes the broad parameters that define the types of jobs the program aims to support, and provides oversight to ensure compliance and accountability. Virtually everything else is handled in a decentralized way, bringing decision-making as close as possible to the people and communities who will benefit most directly from the task that will be performed. The key failure of the program is that it will act as a powerful new automatic stabilizer for the economy as a whole. MMT fights involuntary unemployment by eliminating it. In our view, the most effective full employment policy is one that targets the unemployed directly. Instead of aiming spending at infrastructure and hoping jobs will trickle down to the unemployed, MMT proposes what Bard College economist Pavlina Chodeneva describes as a bottom-up approach. It takes workers as they are and where they are, and that fits the job to individual capacities and the needs of the community. We're not talking about creating just any old job. This isn't a make-work scheme aimed simply at giving the unemployed a shovel in order to justify paying them a wage. It is a way to enhance the public good while strengthening our communities through a system of shared governments. As Vickery put it, these public services would enable us to, quote, convert unemployed labor into improved public communities and facilities of various types, end quote. The idea is to task people with useful work that is valued by the community and to provide compensation for that work in the form of a decent wage and benefit package. If the economy were to crash the way it did in 2008, the federal job guarantee would catch hundreds of thousands of people instead of allowing them to fall into unemployment. The private sector would shed jobs, but new jobs would immediately spring forth in public service. Since the federal government has committed to providing the funding for these new jobs, the downturn is cushioned by an expansion of the fiscal deficit. It happens automatically without any need to wait for Congress to deliberate and hackle over whether to rescue the economy with fiscal stimulus. Because the program supports incomes, the economy stabilizes more quickly than it would in the absence of the job guarantee. The downturn is less severe, and the recovery arrives sooner. And because it's a permanent program, it's there, it's there to buttress the economy in good times and bad. Since it's always in effect, the job guarantee provides for a smoother overall economic ride, which helps to stabilize inflation. Without it, incomes would fall more sharply when businesses lay off workers as customers disappear, causing inventories to pile up and businesses to look for ways to quickly mark down prices to liquidate unsold items. When the recovery eventually arrives, companies can raise prices to reestablish customary profit margins. The more the economy swings around, the more prices may move in response. By stabilizing consumer income, the job guarantee helps to avoid wider adjustments in consumer spending that may result in more price variation. And we've seen this happen. We've seen, oh, okay, a bunch of people leave that job, and then not too long later, the corporate's like, you know what? Since all these people are coming back, we're just going to jack up the prices, and then maybe people buy from us. Price in the economy, the price to paid workers, and the job guarantee program by establishing a wage floor the government sets. The minimum compensation, say 15 an hour, this becomes the rate of remuneration against which all other employment can be priced. Right now, the minimum wage is zero. Yes, the federal minimum wage is $7.25 an hour, but as the economist Hyman Minsky often observed, the minimum wage available to the unemployed is zero. You have to be employed to earn at least the federal minimum wage, and millions of unemployed Americans don't have access to that wage. To establish a universal minimum, there must be a standing offer to bid for labor at some positive price. The job guarantee establishes that minimum bid, making the job guarantee wage the de facto minimum throughout the economy. Once established, any other form of employment would be expected to offer a premium over the best wage. We already do this with interest rates, where the Federal Reserve sets the overnight rate, which becomes the base rate against which mortgages, credit cards, auto loans, and so on are priced. When the Fed raises the short-term rate, other rates usually move higher. By anchoring the price of labor, the job guarantee imparts greater stability across a spectrum of wages and prices in the economy. Finally, the job guarantee helps to fight inflationary pressures by maintaining a ready pool of employed people from which businesses can easily hire when they're looking to expand production. We know from surveys of employers that the least appealing job applicant is the one who has suffered a long bout of unemployment. Employers just don't want to take the chance on hiring someone who has no recent employment record. To extend the possible, they want to know what they're getting. Hiring the unemployed involves substantial risk. There's no way to find out whether the long-term unemployed have retained good work habits, if they can be expected to interact well with others, and so on. An efficient typist or a skilled craftsman may have seen their skills deteriorate from lack of use. You're rolling the dice when you hire someone who's been out of work for a relatively long period of time. To avoid the uncertainty, companies often try to lure their workers away from their current positions by bidding up wages in the level necessary to entice them to switch the jobs. If every employer followed suit, then we're in a game of musical chairs, and those without chairs stay locked out of the game. Bidding up wages in this way introduces an inflationary bias that is mitigated when businesses have the option to hire from a good pool of employed public service workers instead. With the job guarantee in place, employers have an expanded pool of potential workers from which to hire. It benefits only employers and those who would otherwise languish in unemployment, but the rest of us, well. Because it's an automatic stabilizer, the job guarantee moves the federal budget up and down. More money is spent when the economy is weak and less is spent when it grows stronger. Ensuring that deficits move countercyclically to avoid overspending is the area of the budget. Of course, Congress would still retain discretionary control of other parts of the budget as a currency issuer. Uncle Sam wields the power of the purse, and he can always decide to spend more on things like infrastructure, education, or defense if there are goods and services for sale and Uncle Sam wants them. He has the power to outbid the rest of us. He's not financially constrained. As a currency issuer, he has the power to commit to spending more money he doesn't have. And he can't go broke as a result. That's the reality that MMT exposes. As Stan Lee, the creator of the Spider-Man comic books, taught us, quote, "With great power, there must also come great responsibility," end quote. Senator Enzi was right to express concerns about overspending, but he failed to identify the real danger. The threat to our common well-being isn't the budget deficit, it's excessive inflation. So how do we take advantage of the potential benefits that a sovereign currency affords the people of our nation, while at the same time guarding against the risk of overspending? You might be tempted. Give me a second. Tempted to argue that we already have safeguards in place. The debt ceiling limit, the bird rule, And pay-go might look like effective checks on overspending. They aren't. It's not because it's easy for Congress to get around the hurdles. It's because under current budgeting procedures, Congress doesn't have to consider inflation risk when it wants to spend more. Remember, it put the Federal Reserve in charge of price stability, so members of Congress only ask whether new spending will increase the deficit, not inflation. That's the wrong question. In fact, as MMT shows, it sidesteps the great responsibility that should be demanded of any government that wields the power of the fiscal purse. To see why, let's consider an example. Suppose the economy is close to its maximum speed limit, with most workers and businesses already churning out as many goods and services as possible to produce. Now suppose Congress wants to spend $2 trillion modernizing and upgrading America's crumbling infrastructure. Airports, hospitals, highways, bridges, underwater treatment facilities, etc. Because no one in Congress thinks like a current shoe issuer. They all believe the important thing to worry about is whether the spending will increase the deficit. To avoid adding to the deficit, suppose they pair the spending with a proposal to raise $2 trillion by leveling a small tax on a handful of Americans whose net worth exceeds $50 million. Today, that bill would go to the Congressional Budget Office, CBO, where it would likely receive a good score on the grounds that it doesn't add to the deficit over time. With a green light from the CBO, members of Congress would be free to move forward with a vote to authorize the spending. What happens next could be a disaster. As the Department of Transportation tries to contract out the work, it quickly discovers that there aren't enough unemployment resources available for the government to hire. That's because the tax fell on a small number of people, about 75,000, who weren't going to spend much, if any, on that money in the first place. This should not be construed as an argument against taxing the rich, as an argument against arbitrary decision-making when it comes to tax policy. There is a strong case to be made for taxing the rich, and we need to do it, but we need to do it strategically. We recognize that the purpose of the tax is not to pay for government expenditures, but to help us rebalance the distribution of wealth and income because the extreme concentrations that exist today are a threat to both our democracy and to the functioning of our economy. Think about it. Jeff Bezos, the richest man in America. Well, between him and Elon Musk, they go back and forth every day. Has an estimated net worth of $110 billion. A little bit higher now. How many fewer cars after 2% of his wealth is taxed away? The answer is not many. A small annual tax of a fraction of his net worth isn't going to crowd out much of his spending. When it comes down to it, he's more of a saver than a spender. Billionaires save their wealth in the form of financial assets, real estate, fine art, rare coins. A wealth tax might make the infrastructure bill appear fiscally responsible, but it makes a lousy offset if the government wants to increase spending in an economy that doesn't have much available slack. In a deeply depressed economy, this wouldn't matter. There would be plenty of, quote, fiscal space, because businesses would be operating with lots of spare capacity, and there would be loads of unemployed workers available for hire. But as we get close to full employment, these real resources become increasingly scarce. Once the government exhausts its real productive capacity, the only way for the government to get the construction workers, architects, and engineers, steel, concrete, paving, trucks, cranes, and so on that it needs to bid them away from their current use. The bidding process pushes prices higher, giving rise to inflationary pressures. To mitigate that risk, the tax needs to offset enough current spending to free up the real resources the government is trying to hire. The problem is that because this particular tax is leveled on a tiny cadre of uber-rich people, it won't open up much, if any, fiscal space. That doesn't make it a bad idea on the grounds. It just means it's not an effective way to mitigate inflation risk, and that's especially important when the economy is running close to its maximum speed limit. That's why MMT recommends a different approach to the federal budgeting process, one that integrates inflation risks into the decision-making process, so that lawmakers are forced to stop and think about whether they have taken the necessary steps to guard against inflation risk before approving any new spending. MMT would make us safer in their respect because it recognizes that the best defense against inflation is a good offense. We don't want to allow excessive spending to cause inflation and then fight inflation after it happens. We want agencies like the CBO helping to evaluate new legislation for potential inflation risk before Congress commits to funding new programs so that the risk can be mitigated preemptively. At its core, MMT is about replacing an artificial revenue constraint with a real inflation constraint. The reality is that Uncle Sam faces no binding revenue constraint. He spends first and removes dollars by taxing later, instead of starting with the premise that every dollar of new spending should be paired with a dollar of new revenue. MMT urges us to begin asking how many dollars should be subtracted away. This turns PAYGO on its head. Instead of accepting the presumption that we should always avoid adding to the deficit, MMT tells us that to start by asking whether any of the proposed spending needs to be the offset to mitigate inflation risk. Sticking with the $2 trillion infrastructure proposal, MMT would us begin by asking if it would be safe for Congress to authorize $2 trillion in new spending without offsets. A careful analysis of the economy's existing and anticipated slack would guide lawmakers in making that determination. But the CB and other independent analysts concluded it would risk pushing inflation over some desired inflation rate. Then lawmakers could begin to assemble a menu of options to identify the most effective ways to mitigate the risk. Perhaps 1/3 or 1/2, or even 3/4 of the spending would need to be offset. It's also possible that none would be required offsets. Or perhaps the economy is so close to its full employment potential that PAYGO is the right policy. The point is Congress should work backward to arrive at the right answer rather than beginning with the presumption that every new dollar of spending needs to be fully offset. That helps to protect us from unwarranted tax increases and undesired inflation. It also ensures that there is always a check on new spending. The best way to fight inflation is before it happens. In one sense, we got lucky. Congress routinely makes large fiscal commitments without pausing to evaluate inflation risk. It can add hundreds of billions of dollars to the defense budget or pass tax cuts that add trillions to the fiscal deficit over time. And for the most part, we come out unscathed, at least in terms of inflation. That's because there's not normally enough slack to absorb bigger deficits. Although excess capacity has served as a sort of insurance policy against a Congress that ignores inflation risk, maintaining idle resources comes at a price. It depresses our collective well-being by depriving us of that array of things we could have enjoyed if we had put our resources to good use. MMT aims to change that. MMT is about the harnessing the power of the public purse to build an economy that lives up to its full potential while maintaining appropriate checks on that power. No one would think Spider-Man as a superhero if he refused to use his powers to protect and serve. With great power comes great responsibility. The power of the purse belongs to all of us. It is wielded by democratic elected members of Congress, but we should think of it as a power that exists to serve us. Overspending is an abuse of power, but so is refusing to act, when more can be done to evaluate the human condition without risking inflation. Thank you guys for watching. That was Chapter 2. Hopefully tomorrow, sometime this week, I'll be able to do Chapter 3. Hope you guys are, really liking this book so far. I personally do enjoy it myself. There's a lot of context in here that's not talked about enough, and it really gives a brief insight into really the different economic theories and what makes sense, what doesn't, what works, what has failed, and what could be the possible solution to our problems with rising inflation or deflation, or even just stagnant wages or lack of a workforce. So that's what I find is very fascinating, and I am intrigued so much by her work. Other than that, hope you guys have a great day, and see you next time.